Alright, hi class. Really quick recap on the ETF book, Chapter 2, Nuts and Bolts of the ETF. Okay, there's about 20-30 pages of reading here, but we're just going to cover some of the bigger topics. Unlike a stock, the amount of shares outstanding can change on a daily basis. Okay, why is that? I'm going to want you to do some reading on this. Make sure you understand the topic. Basically, the reason why the shares can change on a daily basis is because of an arbitrage mechanism that allows them being a third-party bank, to create and redeem shares to keep the price at its NAV. Basically, they're adjusting for supply and demand. The third-party banks that act with the ETF provider are able to make small guaranteed profits by creating and redeeming these shares. It's basically built into like a fee type mechanism. Okay, there are more similarities than differences between ETFs and mutual funds. They're, at the end of the day, both baskets of stocks. The primary difference, I would say, is that mutual funds tend to be actively managed while ETFs tend to be tied to a benchmark. Okay, so what are the differences? How investors acquire shares. Now, this is a little tricky only because if you were acquiring shares on your E-Trade account, there wouldn't really be a difference. There is no difference. Well, I take a step back. You will only be able to buy the mutual funds at the end of the day. You can place the order at any time of the day. However, the order will only be initiated after the close of the markets, after they're able to calculate the NAV. The ETF trades throughout the day, intraday, like a stock. So selling or buying price can fluctuate throughout the day. Generally, it's tied to its benchmark. It shouldn't deviate too far. So if you have a straight vanilla S&P 500 ETF, it should rise and fall with the overall index pretty closely. ETFs are bought and sold through investors on the public market. The only people authorized to trade directly with the ETFs are the authorized participants. The authorized participants is just another name for those third-party banks that initiate the arbitrage mechanism to create and redeem shares. Okay. What are creation units? You'll want to know that for a quiz. What are the pricing differences? Okay. Be aware of the pricing differences. That's basically what I just told you. With the ETFs are priced throughout the day, while mutual funds are priced once a day. Okay, trade settlement, this is more of a trivial issue. You'll never really need to know this too often, except maybe when you're trading your own account, you don't want to overdraw. Okay, 1 day settlement for mutual funds and a 3 day settlement for ETFs. That means that if you trade an ETF today, you go to sell it, you will not get the cash in your account for 3 days. This can be challenging if you went and made a buy tomorrow on the sale you made today, that you wouldn't have the funds available until 3 days. Okay, authorized participants. APs create and redeem shares to keep the prices as close to NAV as possible. These APs are separate from the ETF organization to avoid self-dealing. Examples of these authorized participants are Goldman Sachs, Smith Barney, and Merrill Lynch. These organizations can make small profits from the arbitrage. This process is highly regulated. I strongly suggest that you do a little bit more reading on this topic in the book. And lastly, arbitrage. If ETFs are selling at a premium, meaning their trading price is higher than the worth of the basket of securities it represents, the authorized participant will buy securities that make up the fund and exchange that basket for a creation unit. This generates a risk-free profit. So they basically create, if the ETF is trading above its market value, right, above its NAV, they will create more units up until the point where there's no more, they're basically increasing the supply to match the demand. That's the idea behind it. Okay, what happens in international markets, and where can there be larger spreads? Okay, I'll answer that question for you. When there is a less liquid market, we expect there to be larger spreads between the buy and sell. Okay. All right, talk to you guys soon.